2013 is in the rearview mirror, and that means it's time to take a look back at what happened in the U.S. apartment market in Q4 and in 2013 overall. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. I'm with Greg Willett, and we're going to take a look at what's the latest from the U.S. apartment market. So, Greg, as we've talked about what's going to happen and what would happen in the fourth quarter of 2013, we talked a lot about how this could be a period of vulnerability for the market. A lot of new supply completing at a time when demand has been traditionally weak. So let's rip the Band-Aid off. What happened with that supply-demand relationship?
You're right. I mean, we were nervous because we were scheduled to see about 70,000 units complete during fourth quarter. As has been the pattern really throughout 2013, you got construction delays. Some of that's weather. A lot of it, though, is labor shortages and just trying to keep a crew on site. So that means some of the stuff that was scheduled to finish actually didn't. So the actual completion number for fourth quarter was 53,300 units. That is a significant number. It is up meaningfully from the quarterly numbers that we'd seen in the first three quarters of 2013, but obviously it's not 70,000 units. So what happened on the demand side? Basically, the demand came in at a little bit less than zero. Our initial calculation is minus 7,300 units for the quarter. That doesn't sound good, but in fact, if you look at historically what we do in fourth quarter, that's not a bad number. The average over the past couple of decades in fourth quarter, we have had net move-outs of 53,800 units. And even if you take out the years when we've been in deep recession, you still lose on average about 36,700 units. So just losing a handful of units means we really did a pretty good job in getting those new units through some lease up there. Let's step back from the quarter and look at the annual numbers for calendar 2013 in total. We completed 163,200 units. That's right in line with demand that came in at 155,500 units. And, the slight discrepancy there, you're talking about product and lease up, and the existing stock really remained completely full. And in fact, the occupied unit count in that stabilized stock actually went up a little bit during the course of the year.
So let's see what those supply and demand numbers did for occupancy. Overall occupancy, and by the way, these numbers do reflect properties that are moving through a lease-up, right now is at 95% even. And that reflecting the normal seasonal pattern, occupancy did backtrack a little bit on a quarterly basis, easing 40 basis points. But again, to Greg's point earlier, that really isn't that bad for Q4. Year over year was up 10 basis points, but both of these numbers are small shifts. The bottom line is the apartment sector is essentially full, and it has been since the middle of 2011.
So let's turn from occupancy to rent growth numbers, and obviously those are really important to the overall performance. And as we came into fourth quarter, really about the best you could expect for the quarter is break even, that we would just really keep the rents that we had in fall 2013. We didn't quite do that. We did see effective rents for new leases dip 0.4% for the quarter. Really that loss coming at the top end of the product spectrum where there is a more competitive environment because of the new supply coming online. Now for 2013 overall, we see that effective rents for new leases climbed 2.8%. The middle market to bottom end communities did the best. Rates were up 3.8% in the 1980s era units and 3.7% in the 1970s vintage stock. Going to that top end, again, more competitive. The rent growth for the year was 1.8%. Really, this last quarter, for the first time, dropping a little bit below that 2% mark, and it is a competitive environment there.
And Greg, give us some perspective here, because rent growth is obviously a big topic for discussion right now. We're clearly past the peak in rent growth for this cycle, and beauty is in the eye of the beholder. So 2.8%, is that a good number? Is it a bad number?
It's an okay number. I mean, it's not a great number, and obviously it is not the 4 to 5% rent growth that we got earlier in the cycle. but it's still a pretty decent number. And really, you kind of have to look at the big picture. And the story of the cycle isn't what is it doing at any given point in time. It's how long the cycle is going to be, given the economics and the demographics there. And if you can sustain 3% rent growth, somewhere around that mark for a long period of time, I mean, that's a really solid performance. And so, investment returns at any given point in time, are they going to be fantastic, off the charts? Not really. But again, over time, it's a great performance, and really limited downside risk is part of that story as well.
And moving on to that big picture storyline, let's take a look briefly at our expectations for 2014. Given Greg's last point about the apartment market's stable results that we've seen of late, we think that's going to be the story for quite a bit longer as well. And so it shouldn't be a surprise that our overall story for 2014 is pretty much more of the same, at least in terms of revenue. We are expecting occupancy to backtrack, but only mildly, down 40 basis points to 94.6%. And that's due to the pretty constant flow of new supply they'll be working through initial lease-up. But the lack of a more severe drop reflects that we think apartment demand should remain pretty healthy in most markets. And rent growth, we think, will remain pretty much on track as well with the current number. We're pinning that number at 2.6% for 2014. And I should point out a quick housekeeping note, we're still fine-tuning some of our forecasts at the market level, so there's a chance these U.S. overall numbers could be changed just a little bit, but the overall number should certainly be close.
And there's a lot more that we can dig into in terms of what's going to shape the performance in 2014. And so, in fact, that's the topic of our next video that we're going to have coming up. And then we're also going to do one on the performance leaders on the metro level during 2013. And then one more forward-looking plug. You and I are going to be at the National Multi-Housing Council Apartment Strategies Conference in a couple of weeks in Boca Raton. We're certainly looking forward to talking to folks there. I'm going to be moderating a session on evolving markets, some places where we think that, in fact, the performance in this coming cycle could look a little bit different than it has in past cycles, as we've had some economic structural changes, different mix in urban core versus suburban environment. So I think that'll be a good session. And, you've got a new baby at your house. And so does that mean that really for the NMHC meeting, that just means a good night of sleep for you?
Well, I love talking about apartment markets, but I could use a good nap.
You are kind of heavy-lidded today. So for the constantly drowsy Jay Parsons now, I'm Greg Willett. Thanks for watching Apartment Market Dynamics from MPF Research.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.